In the 1960s, French finance minister Valéry Giscard d'Estaing coined a phrase to describe the unique financial reality of the United States, an exorbitant privilege. Because the rest of the world used its currency for trade, the U.S. could run massive, permanent deficits without risking domestic economic collapse. This dominance was formalized at the 1944 Bretton Woods Conference. The resulting agreement pegged the global financial system to the U.S. dollar, and pegged the dollar itself to gold at a fixed rate of $35 an ounce. But the system carried a mathematical flaw, recognized by economists as the Triffin Dilemma. To provide enough dollars to facilitate growing global trade, the United States had to run persistent deficits. Over time, the volume of dollars circulating abroad far exceeded the physical gold sitting in U.S. vaults. By August 1971, foreign nations were aggressively redeeming their dollars for bullion. To stop the bleeding of U.S. gold reserves, President Richard Nixon abruptly ended the dollar's convertibility into gold. Severing that tie left the global reserve currency without a physical anchor. The fiat dollar was now floating freely, risking a rapid loss of international confidence unless a new system could be established immediately. A replacement mechanism emerged through a geopolitical arrangement. The United States extended military security guarantees to Saudi Arabia. In return, the Saudi kingdom, led by King Faisal, priced its crude exports exclusively in U.S. dollars. Because Saudi Arabia was the de facto leader of OPEC, other oil-exporting nations followed suit. These countries amassed massive surpluses of U.S. currency, which they then reinvested back into U.S. Treasury bonds, a mechanical flow known as petrodollar recycling. This infographic compares the scale of these commodities. At $1.7 trillion, the global oil market eclipses all raw metal markets combined. By pricing this universally required energy source in dollars, the system generated an inescapable global demand for U.S. currency. This continuous influx of capital suppressed interest rates and established U.S. Treasuries as the world's deepest, most liquid financial safe haven. The U.S. dollar survived the loss of its gold standard by transitioning to a fiat currency floating on a dual foundation: global dependence on fossil fuels and American military projection. Recently, the United States has increasingly utilized the dollar's central role as a mechanism for economic sanctions. This pressure has motivated several emerging markets to actively seek alternative financial networks to avoid potential exclusion from global trade. This official IMF chart tracking the dollar's share of global foreign exchange reserves reveals a measurable long-term erosion. The share dropped from over 71% in the 2000s to around 57% today, pointing to a deliberate diversification by central banks rather than a panic. This pie chart shows the current breakdown of those global reserves. The percentages lost by the dollar are largely being absorbed by non-traditional reserve currencies, including the Chinese renminbi, the Canadian dollar, and the Australian dollar. The underlying commodity is also shifting. Saudi Arabia has pivoted to expand its economic ties with China, signaling a willingness to accept local currencies for oil trades, giving rise to the concept of the Petroyuan. The dilution of dollar-only power is currently happening through a steady, measurable accumulation of alternative regional trade agreements and local currency settlements. If geopolitical frustration is so high and diversification is visible in the data, why hasn't the U.S. dollar been dethroned? The answer comes down to capacity asymmetry. Agreeing to price a shipment of oil in a new currency is mechanically simple. Finding a secure, liquid financial market capable of absorbing hundreds of billions in trade profits is structurally difficult. The $30 trillion U.S. Treasury market remains the only sovereign bond market deep enough to act as a global safe asset. Central banks can park massive capital here safely. By contrast, smaller, restricted alternatives like China's panda bonds simply lack this capacity. Despite deep geopolitical dissatisfaction, the dollar remains the cornerstone of global finance, because no other nation has engineered a financial ocean deep enough to hold the world's savings. The most severe structural threat to the petrodollar loop does not come from rival fiat currencies. It comes from the physical transition away from fossil fuels. Global manufacturing and transportation infrastructure is steadily migrating toward renewable power and electric vehicles. This transition mechanically weakens the financial loop established in the 1970s. As nations consume less oil, they require fewer dollars to conduct their daily energy trade. The petrodollar's foundational loop is slowly unraveling as the global economy decarbonizes, independent of any geopolitical rivals. Looking forward, economists project three potential paths for the global financial system. The first is sustained dominance, where the U.S. maintains its position because its tech sector, its legal institutions, and military backing remain unmatched even as oil fades. The second scenario is a multipolar world. The current structure dissolves into a fragmented system, or the dollar, euro, and yuan share regional influence. The third is a digital leap. Blockchain networks could settle trades instantly, completely bypassing traditional dollar clearing institutions. The petrodollar arrangement that defined the last 50 years is visibly eroding, but the dollar is not facing a sudden collapse. The global economy is entering a prolonged period of complex diversification, testing whether international trust in American institutions can outlast the commodity peg that built them.